after the GFC and particularly after the pandemic, households really delevered their balance sheets. So we're starting from a really good spot. And that means even if things get tighter here for consumers, they have some room to tap into credit.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Hello and welcome to the Bull of Wall Street podcast. I'm Jim Worden, the host for today's session, today's episode. We're thrilled to have Stephanie Aliaga, a global market strategist with JP Morgan, join us. Welcome, Stephanie.
Thanks for having me.
So Stephanie, you and I, you actually talked with our investment committee about a month ago, and we talked about what some things might be happening, but now we're in 2026. By the way, you're the first podcast guest for 2026. Happy New Year.
Happy New Year.
So what are you thinking? What is JP Morgan thinking about the market and the economies for 2026?
Absolutely. Well, thank you for having me. It's a pleasure and also a privilege to be kicking off the year with you guys. 2026 so far, we're starting from a pretty constructive spot for the economy and the markets, which is good news considering we just had 3 banner years in the stock market, right? In 2023 and in 2024, markets were up over 20%. Last year, up another 18%. Everyone's favorite 2-letter acronym, AI, still remains a really strong theme for us and something that we think is going to continue to power earnings in this market. And it's actually going to power a diffusion of that earnings growth. So it's not as concentrated in fundamentals as it has been in prior years. And what's also good about this year is it's not just AI and then everything else looks crummy, right? Actually, everywhere else, we now see an economy that is picking up a little steam next year. Now, at the back of 2025, we had a government shutdown. We had a slowdown in activity associated with a lot of that. We had a slowdown in hiring. We had a lot of business uncertainty because of quick changes on the policy front and tariffs, right? And while we're not fully in the clear, like those headwinds are still there, what is helping us is that the consumer remains resilient and is actually going to get an extra lift next year. And uncertainty is diminishing. And AI continues to power investment spending. And that is something that is actually clouding out other areas of the economy that are seeing much slower investment inertia behind it. So putting all of that together, that's helping other parts of the market that have less to do about AI also see more of a lift this year.
That's fantastic. Well, we're also big believers in AI. A lot of our portfolios have some AI names in there. We continue to also believe what you're saying, that this is going to, really be transformative for a lot of sectors of the economy. We've noticed that more sectors are participating now when we just look at the technicals and momentum, what's working, as well as just looking at broad-based markets. So the Russell 2000, being one of those that we look at, and how many of those companies are participating, by looking at, what percentage are above their 200-day moving average. So that it seems like it's broadening out. It's not just the 7 companies that we talked about for a couple of years. Can you speak more to how some of these other sectors and different sizes and styles, all kinds of companies, shapes and sizes are using AI, and how this might be a market where it's really differentiated between the users and those that are not using it that might get left behind?
Absolutely. So a lot that we can tap into there. Thank you so much. First, let's just talk about the rotation that we saw in the markets a little bit. To your point, it's not just the Mag 7. In fact, last year, only 2 of those 7 names actually outperformed the broad market, the S&P 500. So I think we're soon going to retire this nickname, at least in terms of the cohort, right? AI
Yeah.
is still very much in center, but now AI is not just the hyperscalers or the chip companies, even though they are still big pieces of that story. It's also the utilities, the industrials, the other software companies that are coming in together and fueling this build out. So part
Hmm.
of what we saw last year is just that broadening out in the AI theme, but also these concerns around AI too, and this bubble debate that has been around. And I could talk
Yeah.
about that head on in a little bit too. But I think one thing that that debate has done is also really incentivize people to begin diversifying portfolios a bit more and rotating some exposure away from this bloated concentration of mega cap tech towards other parts of the market that now are seeing better fundamentals. So there you've seen financials and healthcare have also been relatively stronger performers recently. And we think some of this can continue, right? This kind of broader performance in the market. Now, to your other point on AI adoption, this is also really key. And I think I often get asked, what is the next wave of AI? And I get it because it's been 3 years that we've been talking about the picks and shovels, more or less. But I will say, I will caution investors to jump ship too quickly. We're still early in this
Hmm.
AI wave. Generative AI is only 3 years old. And we're learning that in order to achieve our AI ambitions and to use AI in the ways that we expect to, that these, AI leaders expect that we will, we're going to need a lot of infrastructure. And I will make the point that I think we're still early in that infrastructure cycle. So what does that mean? Well, that means that if we're still we're building out this thing, right? Then the monetizers of AI are going to be the ones that are receiving all of that investment. So the
Hmm.
infrastructure names have still been the strongest performers and are the clearest monetizers to AI. But they aren't the only ones. And on the adoption realm, while it's going to be a much more longer phase, it is one where you are already seeing some companies pull ahead. But it is more of a single stock story in financials, in healthcare, and manufacturing, logistics, in venture capital, with all of these young, scrappy, hyper efficient, lean startups that are building custom business specific AI applications. There's a lot of opportunity there, but it is one that it's hard to just play on a sector by sector basis. There's no ETF that tracks that, You're really going to need to lean into active management and remain disciplined around the timing of some of this.
It's interesting. Well, I know I'm using a lot of the AI tools, and I feel like I'm just scratching the surface. But like what you said, I mean, we're still very, very early in this. We've got to build out the infrastructure. There's energy that needs to support that. Are we going to be ready? I just kind of think about California. I'm out in California, and we talked about in California, the politicians in California talked about, oh, well, everyone's going to drive electric cars. This was a few years ago, and then we had a period where they said, no one charge your cars. The grid is overwhelmed. So
We
we're
don't have to talk
we're
for this.
yeah, we're not there yet. I mean, at some point, I guess we will, but like, it's not going to be a straight line. But like, what needs to happen
Oh, yeah.
for all these things to be in place, and for us to really take that next step to, some people call the, generative, what is it? Artificial generative AI,
Yeah.
where it's doing a lot more than just, some chat GPT cues.
Yeah. So, okay, there's a few things I want to say on this. First, to your point on where we are in the adoption timeline and how much compute do we really need. There's 2 things going on right now. One, the pace of adoption of AI is faster than we've ever seen before. In just 3 years, we are at about, at least based on St. Louis Fed estimates from a few months ago, there are about 55% of Americans that use generative AI at least once a week. And those are the people that actually go and use an LLM, not just the ones that maybe are using it indirectly because they're Googling or they buy
Oh,
something
interesting.
online.
Wow.
And you know what? It took 16 years for the internet to reach a similar level of adoption.
Wow.
So it is a remarkably fast rate of adoption. But it's not just that. It's also, the second thing here is the intensity of adoption. And with the advent of reasoning models, which are basically the models that are breaking your query into multiple steps and thinking through it.
Hmm.
And if you're an avid, AI user, you can see this in the models that you prompt. They're going through this
Yeah.
process. All of that requires more compute. And the thing is, if you give them a really tough one and you let them work for 5-10 minutes, it could require many magnitudes more compute. So I think this is important because sometimes people say, oh, adoption is flatlining. There's only so many more people are using AI, but it's not just about the raw number of people who say, yeah, I use AI,
Yeah.
but it's also the ways that they're using AI.
Yes,
And I will
and
say,
the demand on that compute, that's interesting. I was talking to someone, they were saying that, maybe you're paying $20 a month for premium AI, and maybe you put out a query that, you think it's an easy query, but maybe it actually cost $100 for that
yeah.
query. So that mismatch somewhere along the line, someone's going to have to pay for that, right?
Yeah, which gets to the economics around AI right now. And there's been a lot of focus on that in the past year, right? Especially with the growing anxiety around how big this AI bill is coming up to, right? How are we going to make money on this? And
Mm-hmm.
we'll look at the data from the leading LLM companies, and they're losing a lot of money.
Mm-hmm.
But I think what's important to recognize is that's not new. Like that's actually quite common in the early stages of a
Sure.
technology that you're gonna, run at a loss because you're trying to get customers familiar with this completely new technology on board. You're trying to build
Yeah.
scale. It's like Uber and Lyft in the early days. They lured us in, got us comfortable with taking a car with a complete stranger because it was only like $7 to drive from point A to point B. And now we got all the search pricing. They decided it's time to turn to profit, right? So when it comes to AI, I think part of the challenge is, well, it costs a lot more to run an LLM company than it is to maybe have run an Uber or a Lyft. So how long will they be okay with running at a loss? And that's one big question. And then, of course, to your earlier point, what if we don't have the power for all of this?
Yeah.
We think that is like the biggest risk. Number one here is we have a lot of data center construction that is currently planned or underway.
Mm-hmm.
But all of that data center demand over the next few years that's coming online might not meet commensurate new power generation.
Mm-hmm.
We may need something like 100 gigawatts of power to service
Sure.
AI. And you know what's striking? Of all of the data center capacity online right now, only 10 to 13 gigawatts of data center capacity are actually equipped to service AI globally.
Oh, wow.
And we need now 100 gigawatts to achieve all of our ambitions over this time. So that's the big challenge. Now, how are we going to achieve all of this? It's all hands on deck right now.
Yeah.
We need renewables because we have it, solar and wind. But that enough, even if we just put
It's not
all
enough, right?
now, it's not enough. Yeah. We are getting better at storing and better utilizing renewable power, particularly with battery technologies, which have improved notably more recently. But there's been a lot of talk about natural gas. Now, the challenge there is even though we have a lot of natural gas, even to get new natural gas turbines, it's going to take 3 to 4 years, maybe even 7 years because of everything involved in that.
Yeah.
Nuclear has been a big focus because
Sure.
It's AI's dream partner here, right? It's always on. It's carbon free, right?
Yeah.
The problem is, historically, it's taken us 10 years to get a new nuclear plant on board, and they are notoriously expensive. They are very expensive to produce. So that's a risk. I will also say it's also an opportunity for companies that can find themselves in the right position to service this demand, that have the ability to bring new supply onto the market, for even new energy companies at the frontier offering new innovative tech ways in geothermal or whatever it may be.
Yeah.
Everything is on the table right now. So we do think that that's an interesting investment case in some ways.
Interesting. Except for maybe burning coal. Hopefully we don't have to burn coal
Yeah.
to do that.
I know.
Interesting. And we had Ron Barron as one of our guests, and we also had Kathy Wood on prior to that. But this idea of having a data center out in space and being solar powered and cooled by being out in space, that how far away is that? Is that like a decade away or a couple decades, or are we going to get there a lot quicker? I mean, it almost feels kind of like that discussion of self-driving cars. I mean, how many years ago people are like, oh, it's never, ever going to happen. And here we are.
Yeah. And I'll say, look, I won't pretend to have any expertise in how long it'll take us to get there. I am quite skeptical that that would be a really practical solution in the near term. In the long term, for sure. I mean,
Yeah.
we're doing all of this work to figure out how to generate electricity, how to generate power. Meanwhile, the most powerful, always on, free in many ways, right? Power source, right, is the sun. And we've just been figuring out how do we best harness
Sure.
that, So I totally get the dream here, but I am very skeptical of how practical that is, the timeline to how we can get there, how expensive it would be, and of the sorts. But I think it is exciting that, look, how is this all going to solve? How is this all going to get, worked out? It's going to also involve some technological ingenuity, right?
Sure.
I think in the world of AI, we're also going to be using AI to be better at managing the grid efficiencies, right? To be better at managing, maybe be quicker too at getting new energy on board, even giving the government like AI tools so they can scan through all of these proposals and applications quicker. So I think there's a lot that AI can potentially do to just expedite this build out as well.
Oh, 100%. Like just from an efficiency standpoint, I feel like there's huge gains there. Well, so we've spent some time talking about AI. Let's now talk about AI and the consumers. And, we do have this kind of K-shaped economy where some people are doing incredibly well. They are owners of assets. Other folks are struggling. They're still struggling from the inflation that we had a few years ago. And even though we kind of talk about, well, the rate of inflation is coming down, there's a downtrend, like they're still paying prices well above where, they were in 2019. So does AI help some of those folks, or does this kind of, wealth gap get bigger over time? What is JP Morgan thinking? What are you thinking about this?
Absolutely. And I was just pulling up one of my favorite slides from our guide to the markets, consumer finances. We actually have two consumer slides there, but to talk through a little bit of what we're seeing here on the consumer side, because there's been this really head scratching disconnect between consumer sentiment, which has been near historic lows. It's like at secondary levels. It is down in the dumps, right? Versus spending. Last quarter was a great quarter for consumption. This holiday season fared pretty well, right?
Yeah.
So, and this has been the case even last year. And it might have something to do with how polarized the political climate is, right? How social media and all of this have really, polarized public sentiment. How you feel about the economy can be completely different than how you feel about your own personal finances. Like you're still going on great vacations, but meanwhile, you're like the biggest critic of the state of the U.S. economy. So there's been some of those disconnects, right? Which is why it's not really the best gauge to just look at consumer sentiment to give you a lot of directionality as to where the economy is going and how consumers are really doing. And then the other thing to keep in mind when it comes to the economy, it counts by dollars, not heads.
Yeah.
In sentiment surveys, everyone gets a vote, right? But that's not the case when it comes to GDP.
Sure.
And we've had significant amounts of household wealth creation in recent years coming out of the pandemic. Now, it's benefited those with home equity and investment equity, right? Investment assets
Hmm.
predominantly. But that household net worth gain is also something that's giving consumers this added cushion. It's helping them feel better about spending money. And so
Sure.
I think that's what we're seeing is that top 20% have been really powering a lot of the consumption in the economy. And then the good news this year is that the bottom 80 are going to get a little bit of help too, right? We're going to
Mm.
get higher than usual tax refund checks because of the one big beautiful bill.
Yeah.
And for everyone that receives a tax refund, we think on average you're going to get $800 more
Hmm.
than you've gotten historically. And that's going to act like a little bit of a stimulus check, right?
Yeah.
Helping power consumption. So that's the good news for the consumer. The last thing I'll say, the other thing to keep in mind when it comes to sentiment and so forth is one really good metric to look at is just household debt, right? Household leverage.
Hmm.
And I've had so many times like clients have asked me, well, credit card debt is at all-time highs, and all this stuff. And like, yes, when you look at nominal figures, they tend to
Yeah.
grow year after
Yeah.
year.
Yeah.
But you have to look at this debt as a share of the amount of money, the disposable personal income that
Hmm.
consumers have right now. And as of the last quarter, we estimate that that's at 11.6%. So debt payments is a share of disposable personal income. And here's the thing, it is lower today than it was before the pandemic. And it
Oh,
is far
interesting.
lower than where it was in any of the years preceding or even following the global financial crisis.
Hmm.
Because what has happened is after the GFC and particularly after the pandemic, households really delevered their balance sheets. So we're starting from a really good spot. And that means even if things get tighter here for consumers, they
Hmm.
have some room to tap into credit to fill the gaps.
Interesting. Well, and so between what you're saying with the big beautiful bill and some tax refunds, and then you also have the Federal Reserve that's likely going to cut a few times too. Shouldn't that also help a little bit?
It will help in some areas, and particularly anything that is has a floating rate, right? So a
Yeah.
variety of different kind of like household credit vehicles, right? Auto loans to some degree, credit cards maybe benefit from that. But we're talking
Hmm.
about like 50 basis points of
Yeah.
cuts
It's
this
not.
year.
It's not huge.
It's not huge.
Now, is J.P. Morgan? Are you of the belief that the unemployment is a bigger risk to the economy, or is inflation a bigger risk, or is it about balance? Because that's kind of I feel like we've gone back and forth some on that, over 2025, and curious what your thoughts are for 2026.
What the big boogeyman for the economy may be.
Yeah.
Um, I think I would say in terms of the Fed's mandate, you have employment and inflation. I'm actually more concerned with the inflation part because, and before I get there, I'll say why I'm not as concerned on the employment side. Last year, we saw a pretty material slowdown in hiring. The average job growth rate for the last 3 months has been something like 50,000, I believe, 22,000. And in November, it was 64,000. This
Mm-hmm.
year, we think we'll probably average around 60,000 jobs a month. But the
Mm,
thing is, you can't just compare the numbers to where we were the last 2 years. Because when we
sure.
were adding 100,000, 200,000 jobs a month, it was a very different economy because we were
Hmm.
adding a ton of workers into the labor force. We were in the midst of a boom in immigration, right? And we had significant pent up demand for workers coming out of the pandemic. So that was that dynamic. Today, we're in a much more balanced labor market. Employers are kind of good with steady headcount right now. There are some areas where they're adding, some areas where they're cutting. The reason why we don't think that we're going to see a ton of layoffs this year is because what tends to really make businesses lay off a lot of workers? It's when the economy
Slow
really
down.
begins to slow down,
Yeah.
when they get more cautious. And that's a bit of
Sure.
what we saw last year. There was a lot of uncertainty, tariffs,
Hmm.
what are you going to do when there's a really uncertain business climate? You're going to hold off. You're going to make your current workers do more work because you don't really know if you're going to need those new workers or not because you don't know what your
Yeah.
demand's going to look like. But
Hmm.
now companies can kind of, okay, they have a better sense of what they're looking at. And what they're looking at is an economy that's actually going to do quite well, poised to do quite well this year. So we think that employment is likely going to stabilize, if not grow a little bit. So we see unemployment kind of stable at about 4.5% this year. That's good news. Now, on the inflation side, I think the challenge here is you have tariffs that are still making their way through the economy. And even though we're past peak when it comes to like the stated statutory
Mm-hmm.
tariff rate, we're not past peak when it comes to the tariffs that consumers are paying,
Mm.
because different pieces of the supply chain have been taking on that burden. But as consumers continue to fare well, get a little lift from tariff
Yeah.
refunds or the tax refunds, then that's going to be passed through. So you have tariff inflation, though we know that's temporary. We know that's not
Mm-hmm.
any source of sustainable inflation growth. But if you pair that with a Fed that is still easing, and
Mm-hmm.
maybe with this new Fed chair, like language around that is quite easy, you could see inflation remain sticky for some time, which is a bit of a risk, we would
Yeah.
say.
It's interesting. Do you guys, well, I know you're part of this long-term capital markets assumptions committee with JP Morgan, and that's probably got to be a challenge in and of itself, because you're trying to forecast next, I don't know, 5, 7, 10 years for different asset classes.
Yeah.
But I'm thinking about demographics. There's these demographic changes, and there's aging demographics, and there's of course immigration policy, geopolitics. There's all kinds of stuff that I feel like would throw a wrench into anyone's assumptions. How do you work through that and around that? And are there areas that surprise you as you meet as a committee to say, this asset class we think is going to be outperforming the others, and maybe it hasn't for some time? I don't know if that's international equities. That
Yeah.
it feels like it finally had a really good year after a number of years of underperforming. What's kind of your inside view on that committee, and what are you looking at, and what things are changing?
Yeah. Well, it's one of the most intellectually fun parts of the job. Is every year for a few months we kind of put our heads down and we try to zone out the noise of the current political policy climate, market climate, and just really ground ourselves in the fundamentals, right? What should, over the long haul, in our 10 to 15 year horizon, average out to really drive returns. And so I sit on the macro committee. So hand in hand with David Kelly, we're thinking about the long run outlook for growth and inflation. It's actually where my research in AI began, was thinking about, and also pitching to the committee that we got to start boosting our productivity numbers, because this new transformative technology is underway. And we've now, for the last few years, been gradually including, that constructive outlook on AI and productivity. But what's also happened, particularly this year, is we do have a better picture on productivity. But there's like two ways to grow an economy, right? It's very simple. You either get more productive or you hire more workers, right? You grow your workforce. And on the latter front, that estimate, the contribution to growth over the next 10 to 15 years, that's gone to zero. So essentially, something that was actually driving a good bit of economic growth historically is now no longer doing that. And in fact, is posing a pretty meaningful headwind. So
is that more because of immigration policies, or is that more because of like the baby boomers retiring, or is it kind of a combination of both? That's interesting.
Yeah, because we have, declining birth rates. We have just an aging population because of the baby boom, right? And all of that. And we're not bringing as many people, new people into this economy that are working and contributing. And immigrants tend to be younger and also have a very high labor force participation rate.
Yeah.
Well, it's hard in our forecast. We don't make any kind of speculations, really. So when it comes to immigration, it's tough, because even in the last couple of years, you've seen policy really have a pendulum swing, right?
Sure.
And we're in one direction, very restrictive. And the question is, does that move again? And when it does, we will put that into our assumptions. But right
Interesting.
now, that's the picture. And so how does that flow through to our asset class return assumptions? Well, there's a few things that have been really top of mind for us. The US has been running a persistently elevated deficit, but a lot of that deficit, it's not going towards investing in great programs that'll fuel growth, that will reskill our workers or whatever it may be. A lot of it's going to financing our debt, right? Coupon payments.
Hmm.
Take almost like half of the expected growth in our deficit over the next 10 years is just going to paying like the bills on our debt every month, right? But the rest of the world is very different. In Europe, even in some parts of emerging markets, you have economies opening their fiscal purse and investing in their economies, and that's providing a growth dividend that hadn't been there before, right? So there's that. There's positive corporate structural reforms in Japan, but also in Europe. There's also just the fact that other economies don't have the same demographic challenges in emerging markets, in India in
Oh,
particular.
yeah.
So there's these really exciting stories happening. When it comes to asset class returns, I mean, I think it's that growth story. It's also valuations, right? Valuations are just a much lower hurdle to
Sure.
reach for some of those international economies. But then again, with the US, there is no other economy that matches in terms of just the raw profitability and exceptionalism in the companies in our economy, right? So it's like not necessarily US exceptionalism, but exceptional US companies that's
Sure.
helping drive this. So actually our estimate for, what average S&P returns only really came down a smidge this year. And that's remarkable because of how much we've already seen in terms of overall stock market performance.
Yeah. Wow. That's incredible. And sometimes we have the debate, internally, and we talk to other folks about, valuations, and we always talk about, well, there's growth. I mean, if you're going to get all this growth, then, maybe that valuation that's a little bit richer doesn't have as much impact. I would be more concerned if, we've got high valuations and profit margins are getting smaller and the growth is, I would be wary of things like that. But,
Exactly.
a lot of areas we're getting so much growth.
Yeah. US equities are expensive, but they're expensive for a reason, right?
Yeah.
And it's that growth story. And what's remarkable, even last year, but despite an 18% gain in the market, which is like a great year by however you want to cut it, right? Valuations, the forward PE on the S&P only rose 3%.
Yeah.
So everything else was driven by earnings.
It's
And we
earnings.
think that
Yeah.
this year will be more of the same, right? It's that earnings story, the fundamentals that are really driving the market higher and allowing us to maintain this premium relative to many other assets.
So does JP Morgan, do you guys actually put out a price target for the S&P 500 or things like that? We're fairly bullish. A few months ago, I was not as bullish, but as I see more and more of these companies participating, more sector participation, and just the margins improving and revenue improving, we actually got a little bit more bullish toward the end of the year.
Yeah.
What are you guys thinking?
So formally, our team does not put out a price target.
Oh, you don't? Okay.
There are other houses at JP Morgan that do. We're a big shop, but I will say that we do share, similar to those other teams that do put out price targets, a pretty constructive outlook on the markets. And if we have a market that is driven by earnings growth, and we think a mid double-digit return, markets are currently expecting 15% for the year.
Yeah.
That seems, somewhat reasonable to us.
Reasonable,
if
yeah.
We see this bullishness around AI and just the real demand showing up in the monetization of AI in different sectors, right? We think that that's reasonable. So you could see another double-digit return in markets. But I think what I would say for investors is what to do with that,
Sure.
Even though we don't think that there is this big bubble in the markets around AI, that doesn't mean that there isn't risk of a big correction. And the way that I like to think about this is that this AI boom, it's not levered with debt like many other
Hmm.
CapEx booms have been historically. That's something that's really important here. But I will say that we are levered to expectations.
Hmm.
And what's keeping valuations reasonable here is that E component, right? And that E component is also a picture of really robust growth in earnings.
Hmm.
But where we're really sensitive is in any changes in the math here. And that's why people have been talking about what happens if the useful life of chips is a bit smaller than these companies are currently modeling out.
Hmm.
What happens if we mistime energy generation and the data center build out and we have data centers sitting vacant for a few years because they
Yeah.
can't plug into anything, right? What if another DeepSeek moment happens of a different
Mhm.
flavor and the competitive dynamic shifts? Some other company figures out how to, um, mask or sorry, also produce something similar of like the NVIDIA GPUs. Like who knows what it is,
Sure.
right?
Yeah.
And I think that's just the thing, the humility that we need to carry as investors and
Sure.
ensuring that our portfolios are built to withstand whatever disruption may come. Because in
Hmm.
a world of AI, disruption is going to be a feature, not a bug.
Yeah. That's so true. Well, I mean, we own a small amount of a quantum company, and looking at that, and there's some of these are very, very volatile. First of all, but the idea of something else coming along, and the idea of disrupt the disruptor, right? If they can do something quicker and with less energy, and maybe it's not something that's a replacement, but maybe it's an augmentation. It's this technology paired with another one is better than the original technology. I don't know. I mean, I don't have all the answers, but I do think it's fascinating, like how fast paced things are going, and maybe AI kind of helps problem solve some of these things. I'm excited for what lies ahead in terms of like healthcare, and being able to create these drugs that can cure diseases, or gene editing. All of these things, I feel like
Yeah.
there's a lot of good. There's some
So,
things that I worry about too, as it relates to privacy and
yeah.
social interaction. I just get concerned with even just social media, um, and what's real and what's not. But I guess we just have to travel through that together, right?
We are living in such a unique and fascinating time. It's amazing. But on the healthcare side, I'm similarly really excited. I think I will say just this weekend, me and a friend, we were trying to kind of use some of these tools, right? And I was trying to build out some agents myself, build out a website with Lovable, kind of like walk the walk versus just talking about AI.
Yeah.
And, what one of my friends did was he had done a 23andMe kind of thing, like a DNA swab,
Sure.
put his DNA into Claude Code and had Claude estimate all of these things about him, like the likelihood of what diseases he might be more privy to. Apparently, his DNA shows that he's also like is a fast metabolizer of caffeine. Like all of these
Oh,
really fascinating stats. It was
interesting.
crazy. Yeah. Now
Yeah.
I haven't done one of the DNA exams myself because it's a privacy issue
Yeah.
too, but it's just one example of the information that we're going to be able to extract from healthcare data, which comprises a lot of data out there. I think the stat is like three-fourths of all the data outstanding is like health related.
Mm.
And it's actually quite new that we've been able to leverage this data because for a long time, where did healthcare data sit? It sat in like file cabinets in doctor's
On the
offices
shelf somewhere. Yeah.
on the shelf somewhere. The digitalization of healthcare data is actually a relatively new phenomenon, and
Mm.
now it happened at such a great time for AI models to now make use of that data. But I will say it's not going to be straightforward, and I love telling people about the story of what we've seen in radiology because I think it has so many really great lessons here, but also on the jobs front, right? The question of, is AI going to take our jobs? So what have we seen in radiology? For years, the leaders in AI have been using radiology as an example of AI's coming for your jobs.
Mm-hmm.
Because if your job is to just, analyze and try to detect patterns in medical images, you can train an LLM to do that with
Sure.
great precision, right? And it's true. We've had now 700 FDA approved AI radiology tools already
Mm.
on the market, used in hospitals
Wow.
and so forth. What's happened to radiologists? As of 2025, they had the most placements than ever. So job growth has risen.
Oh, wow.
They are now the second highest paid profession in medicine,
Hmm.
and they're busier than ever. So, one profession, a white collar profession that is uniquely exposed to AI disruption, busier than ever. Why is this the case? And this gets to the point of what we're going to see in healthcare. Well, it turns out when you bring these models into the real world and you give them real life cases, right, they don't perform as well as they did in their testing environments.
Mm-hmm.
And if you get it wrong at the hospital and you misdiagnose, that is one of the most expensive mistakes that you can make. So there's
Sure.
been a lot of pushback from insurers, from hospitals, from the doctors themselves, and using these tools. Now, eventually, we're going to get better models that get it right
Yeah.
often. But to get there, right, you need to access really sensitive personal data. And that whole process of getting approved anonymized data also takes time.
Yeah.
So I think the challenge is in many of these use cases, it's going to take time. There is still really high hallucination rates, even from the LLMs that we use every day. I was shocked
Hmm.
that even like the best models from Claude have a 40% hallucination rate. That is the
Mm.
best relative to all of the other LLMs out there. And they actually go up to the 80s and 90%. And that is like current data, which is shocking, right? So one of the challenges when it comes to the adoption of these tools is that it's one thing for AI to be able to do something. It's a completely different thing for it to be able to do it reliably. And
Hmm.
that might be a much longer challenge.
It's fascinating. Well, you and I both work in finance, and I know that AI models can now pass the CFA, all three levels. I think they can pass like the bar exam. But talk about your journey and getting to starting with JP Morgan, where you're at, and like how might you use AI? Because I'm trying to use it, and I think it was Jensen Huang who said it's AI is not going to replace your job, but it's going to replace the person who doesn't use AI. So how is it going to change your job, my job? How do we leverage it more? And then what are the things that our industry, I guess our sector as a whole, finance seems to be very, very slow to adopt new technologies. And we see that with trade settlements and hopefully blockchain, makes things better. But what do you think about you personally, your journey, where you've been, where you're going, and then just, as a whole, where is the sector going?
Yeah. So I'll talk about my AI usage, and then if you want, we could talk about kind of how I got here and everything before AI, right? But
Yeah,
like first, when it comes to AI, I started as a research analyst, right? I was working closely with David Kelly, and I get to go to this, this policy conference every year where I get to sit with a bunch of economists and hear from Fed speakers and different, really,
sure.
amazing thought leaders from across the industry. And it was in that room in February of 2024, just a few months after ChatGPT was launched. Sorry, 2023, which is a few years after ChatGPT was launched,
Yeah.
when I realized how much of a game changer this would be. And that led into like a research rabbit hole that now has become kind of my specialty on the team.
Yeah.
And then in the last few years, I've also begun leaning into these tools myself as a practitioner. And I will say,
Sure.
AI has been the number one upgrade to my quality of life. It's
Wow.
been amazing the ways I use it. And my advice for you is one, buy a premium model. Like
Yeah.
you will get magnitudes more value out of it than $20 a month. But buy the premium so you can use the premium intelligence and also to just help you be honest yourself too of using it more. And the thing
Yeah.
is like any new technology, we're only going to get better at using this the more that we use it.
Hmm.
So bring it into everything you do. Bring
Yeah.
it into any kind of challenge. You have a always on, hyper personalized, hyper customizable problem solver at your fingertips. And that's amazing. I'm trying to figure out what workout I'm going to do with the gym. I'm asking AI to put it
Yeah.
together and then for it to remember my preferences. I use it a lot to help me brainstorm, to help me keep track of notes. A part of my job, I'm always reading and getting up to speed on things. And it's been like a hyper personalized tutor in so many ways, right?
Sure.
I can just on a walk brainstorm and brain dump into speak to it, and kind of get all of my thoughts together, which has been
Hmm.
really helpful. I'm at the early stages of this, but I really want to start building out charts as well, and also building out some kind of agentic systems of how I can better track markets. And even, I will say, part of my job too is public speaking. I have fed AI videos or recordings of my interviews. I've asked it for feedback. It's my presentation coach. It knows all my New Year's resolutions. And now we work through some milestones together, and I've built out a tracker on Lovable to like
Wow. That's great.
so yeah, I'm a growth-minded person, as I'm sure many of you are. And so AI has been my sidekick along the way, and it's been really remarkable, but it's only as useful as you enable it to be. And
Yeah.
so that's the one thing I'll leave with you guys.
Well, I think you hit the nail on the head. You really have to force yourself to use it, and not just use it in one way, use it in different ways. I'm using some of the premium models, but yeah, I need to, like, it's always fine tuning, optimizing. How are you using it? I will say that my wife and I went out to Kauai prior to my son's graduation, and I had it planned, the full itinerary, what we're going to do, what day, and it did it, and it built a website. It's like, it was pretty wild. What it can do. It would have like made the reservation for the helicopter tour and all that, but I was like, well, I actually want to reserve that myself. So,
Kauai is one of my favorite places. I went twice this year. So, and AI helped me too. Maybe
yeah.
give us some of the recommendations. It's a small island, but that's great to hear. Yeah.
Interesting. Well, any final words for us, Stephanie? This has been fantastic. I love talking to you, hearing your perspective, hearing what JP Morgan's thinking is on different things. Anything else that I should have asked you that I didn't?
Well, I think it's been a really great conversation. Thank you so much for having me.
Yeah.
I will say, on the AI topic, I spoke about it at length, but I'm sure there's questions. And if you're interested, I would say follow me on LinkedIn. I share a lot of my insights there on AI and the broad markets. Our website also has a really great landing page associated with this. So jpmorgan.com/AI hub. And then, of course, we also are thinking beyond AI, right? So our year ahead outlook is also at jpmorgan.com/outlook, with a lot of our different insights on the economy, asset class preferences, and so forth. So I would end with that. And then otherwise, feel free to send me a note on LinkedIn and tell me how you're going to be using AI this week. And hopefully that's one great takeaway for you all.
All right. Well, great. Thank you so much, Stephanie. This has been fantastic.
Here's Three's company too. Come and dance on our floor. Take a step that is